Welcome to the Deep Dive, the show where we take a mountain of information and distill it into pure gold just for you. Today, we're plunging into a topic that has captivated brilliant minds for centuries, the stock market. Specifically, the incredible allure and equally incredible challenge of predicting its movements. It's a central focus in financial research, promising immense opportunities for informed decision-making. But here's the reality. It's notoriously difficult. Why is that? Because financial data is inherently nonlinear, high-dimensional, and incredibly volatile. It's a truly complex system.
It absolutely is. And what's fascinating here is that traditional methods simply aren't equipped to handle that kind of complexity. It's often felt like, trying to catch smoke with a fishing net. But today we're going to explore a novel, multi-layer hybrid multitask learning, or MTL, framework that's specifically designed to tackle these deep-seated challenges head-on.
Okay, MTL. So our mission today is to unpack how this advanced approach ingeniously combines different AI technologies to achieve, well, significantly more accurate and robust stock market forecasts. Think of it as your shortcut to truly understanding what's important in this rapidly evolving field. Let's dive in. So, to really appreciate the innovation we're discussing, we probably need to trace the journey of stock market prediction a bit. It started, like most things, with simpler methods, didn't it? Those early attempts relied heavily on traditional statistics.
That's right. Models like ARMA, ARIMA, and JRCH were foundational. They primarily relied on historical price data, trying to find straightforward patterns in past movements to predict the future. They were, breakthroughs in their time for linear systems.
Right, for linear systems. And while they were a critical starting point, what were some of the fundamental limitations? Why weren't they enough for the true complexity of the stock market?
Well, the main issue, as you touched on, is their fundamental linearity. Financial data, by its very nature, is chaotic and anything but linear. It's non-stationary and incredibly noisy. These models struggled to adapt to sudden market fluctuations and often required a lot of manual tuning, which led to suboptimal predictions in the real world. They simply couldn't capture the messy, dynamic, and interconnected nature of the market.
Okay, so that takes us to the big shift, the rise of artificial intelligence, particularly machine learning and deep learning. This marked a profound leap forward, proving far more accurate, but even here there were still hurdles to overcome, right?
Precisely. Deep learning, with its multi-layer neural networks, really changed the game. Models like convolutional neural networks, or CNNs, and recurrent neural networks, things like LSTMs and GRUs, started showing a much stronger ability to learn and generalize from complex nonlinear data compared to their traditional predecessors. However, many of these advanced techniques often analyzed individual stocks, well, in isolation.
Ah, right. And that's where something crucial was often overlooked, what you called the spatial dimension. What exactly does that mean, considering the spatial dimension here, and why does it matter so much?
It means we weren't fully considering the intricate relationships between different stocks or even different market indicators. Stocks don't operate in a vacuum. They influence each other. Think about, say, a major news event hitting one sector and how that ripples through related industries. Empirical evidence strongly suggests that integrating this relational information among stocks, how they interact and influence one another, significantly enhances predictive accuracy. Simply put, understanding the network is just as vital as understanding an individual stock's history.
And that brings us to where it gets really interesting. The power of hybrid models, often under the umbrella of ensemble learning. This approach combines multiple techniques, and it seems like it's shown significant advantages in financial forecasting.
It certainly has. Ensemble learning models have proven exceptionally adept at improving accuracy and, crucially, mitigating overfitting issues that can plague single models. It's about leveraging the unique strengths of different approaches to create something far more robust and reliable.
Okay, and that leads us directly to the core innovation we're diving into today. This novel multi-layer hybrid multitask learning, or MTL, structure, this is presented as the next evolution, designed to achieve even more efficient and accurate stock market predictions.
Right. And this framework isn't just a mix and match. It's a strategic fusion designed to conquer the market's chaos. Imagine a transformer excelling at spotting the hidden connections between all sorts of market data points, like a master detective identifying subtle links. Then, a BiGRU comes in, perfectly tracking the evolving story of price over time, processing the sequence both forward and backward, catching every nuance in temporal patterns. And finally, the Kolmogorov-Arnold Network, or CAN, acts like a precision lens, sharpening how the entire system learns the market's tricky, nonlinear quirks. The real insight here is that by weaving these three distinct superpowers together, you get a model that doesn't just predict, but deeply understands market volatility from every angle simultaneously, optimizing everything at once.
That sounds incredibly powerful, but often integrating multiple complex AI components brings its own set of challenges, like, increased computational load or difficulties in fine-tuning. How does this specific framework navigate those common pitfalls beyond just being robust?
That's a very good question. The hybrid nature here is really about complementary strengths. For example, while transformers are powerful, they can be computationally intensive and don't inherently have a strong time series bias. So pairing it with a BiGRU in CAN helps address those potential limitations. The BiGRU provides that inductive bias for sequence data, and the CAN helps ensure efficient and precise nonlinear learning. This can reduce the need for extensive manual tuning and lead to faster convergence. It's about smart design to try and avoid those typical integration hurdles.
Understood. So let's break down these three key pillars you mentioned. First up, the transformer encoder. What's its primary role here?
Okay, the transformer encoder. It's designed to extract those complex correspondences between various input features. Transformers, with their attention mechanism, are excellent at capturing long-term dependencies and multidimensional features. They can really see how different pieces of information relate, even if they're far apart in a sequence. Think of the multi-head self-attention mechanism using 4 attention heads in this model as having multiple focus spotlights, each looking for different intricate patterns in the data all at the same time.
Got it. So it's about identifying complex relationships across the entire data set. Okay. The second pillar is the Bidirectional Gated Recurrent Unit, or BiGRU. What role does this play in capturing the market's pulse?
The BiGRU is all about capturing long-term temporal relationships. Think of financial time series data, like a continuous conversation. A standard GRU processes it in one direction, like listening from beginning to end. But a BiGRU processes that time series data in both forward and backward directions. This allows it to adapt to complex sequence patterns and effectively capture two-way dependencies and interactions between multiple variables over time. It gives you a much richer, more complete understanding of the temporal dynamics, catching nuances that a single direction model might miss.
And finally, the third pillar, which sounds genuinely novel, the Kolmogorov-Arnold Network, or CANA. What's its contribution to this system?
Right, the canon. It's there to supercharge the learning process and better approximate the market's incredibly nonlinear movements. The real novelty is that CANs are designed to be incredibly flexible. It's almost as if the network itself can adapt its learning pathways on the fly. This means it's far better at precisely modeling the erratic, unpredictable behavior of financial data. It can lead to faster learning and greater accuracy, especially in high-dimensional settings. It's a really clever way to handle that inherent market nonlinearity with precision.
Okay, so these diverse inputs pour into the system. You mentioned things like opening price, closing price, volume. Can you walk us through briefly how each of these layers, the transformer, BiGRU, and CAN, contributes to transforming this raw data into those robust predictions for both volume and amount?
Absolutely.
Yeah.
So imagine the transformer first, sifting through all these indicators: opening price, closing price, lowest, highest, trading volume, trading amount. It identifies the underlying correlations and long-term dependencies between them, even if they seem unrelated at first glance. Then the BiGRU takes that enriched understanding and processes the time series aspect, looking both forward and backward to catch all the subtle temporal patterns and evolving relationships over time. It gets the flow. Finally, the CAN refines all of this, making sure the model's overall learning for nonlinear market movements is as precise and adaptable as possible. This seamless multi-stage processing ultimately yields those highly accurate, simultaneous predictions for both trading volume and trading amount. It's a multitask output.
Okay, that all sounds incredibly advanced, but the real question is, does it actually work? Let's talk about the proof and the performance, unpacking the results. Before we dive into the numbers, can you quickly remind us of the 4 key metrics used here and what a good score looks like?
Of course. The 4 key metrics are MAE, RMSE, MAPE, and R12. MAE, mean absolute error, measures the average absolute difference between predicted and actual values. Lower is better, indicates stronger prediction ability. RMSE, root mean square error, is similar but penalizes larger errors more heavily. Like MAE, lower is better. MAPE, mean absolute percentage error, gives you a relative error measure, which is useful for comparing across different datasets. Lower MAPE means higher accuracy. And finally, R squared, or R1, measures the proportion of variance in the actual data that the model can predict. Here, a higher R indicates a stronger fit, so higher is definitely better.
Okay, lower for the errors, higher for R squared. Got it. So with those in mind, how did this proposed method stack up against the competition, against other advanced methods?
Well, the experimental results were genuinely impressive. When compared against other representative advanced methods, this new approach achieved an RMSE of 39.820. Now, that's a 17.2% reduction compared to other top models. That shows significantly greater robustness in handling large market fluctuations. Its R-edge reached 2.977, outperforming others by 4.2% and 3.1%. This isn't just a minor improvement, it powerfully highlights the model's superior predictive performance in capturing both short-term variations and long-term trends.
Wow, 17% lower RMSE, that's quite a leap. But what about when they compared it to ablation methods? Where they essentially took out individual components of this hybrid framework? That's where you really see if each piece pulls its weight.
Exactly. And that's where you truly confirm the synergistic power of the combination. When compared to models with individual components removed, the full proposed method achieved an RMSE of 21.004. This is a massive 39.7% less than the next best performing hybrid. That indicates far greater stability, especially in high volatility data like stock prices. Its RAP of 0.968 also verified a much stronger fitting ability. It really shows that all three components working together are absolutely essential for this level of performance.
So beyond just the cold, hard numbers, were there any qualitative advantages shown in the results? Like what did the visualization of its predictions tell us?
Yes, absolutely. The visualizations were quite revealing. The model maintained high consistency with real values. It accurately captured overall trends and, crucially, those critical inflection points, the peaks and troughs that are so important for investors. When you talk about filtering out noise in high-frequency regions, it sounds like the model has an exceptional ability to cut through the chatter, to hear the real signal. It exhibited good robustness by effectively filtering out noise in high-frequency fluctuation regions, making the prediction curve smoother and closer to the actual values. This means it's not just getting the general direction right, but the crucial turning points too, which is vital for any real-world trading application.
And what about efficiency? Because a model can be super accurate, but if it takes forever to run, well, that's a non-starter in fast-moving markets.
Efficiency is absolutely crucial in real-world applications. And yes, it performed well here too. The proposed method demonstrated a faster inference time of just 0.0193 seconds. This is a significant improvement compared to other state-of-the-art methods, which range from 0.0199 up to 0.0284 seconds. Faster predictions translate directly into more timely and agile decision-making, which is paramount in financial markets.
Faster, more accurate, okay? And to really solidify its reliability, what did the cross-validation results show?
The cross-validation results confirmed the robustness and reliability of the findings across different datasets. They achieved an average test R of 0.9831. This really solidifies the confidence in the model's consistent high performance.
Wow, what a deep dive indeed. So to quickly recap, we've just explored how a novel multi-layer hybrid multitask learning structure is truly, well, it seems like it's revolutionizing stock market prediction. By ingeniously combining a transformer encoder for that powerful feature extraction and understanding relationships, a BiGRU for capturing the full temporal story, and a Kolmogorov-Arnold network to enhance learning and model nonlinearity, this framework really tackles the extreme challenges of the market.
And the experimental results really do speak for themselves. We saw that impressive RMSE of 21.004 in ablation tests, almost a 40% reduction in error compared to the next best hybrid, and that average test R of 0.9831 in cross-validation. It just highlights its robustness and predictive accuracy. It's achieving truly unprecedented performance by capturing those complex, dynamic relationships in ways previously, well, very difficult to achieve.
So what does this all mean for you listening? This isn't just about impressive numbers or abstract AI concepts. It's about providing critical, actionable insights for investment strategies and enabling more effective capital allocation. What's truly fascinating here, I think, is how the deliberate synergistic combination of these complementary learning techniques can capture the incredibly complex dynamic relationships in financial markets. It leads to models that don't just predict, but genuinely understand volatility. And this raises an important question for you. How might this approach this idea of integrating diverse perspectives and specialized tools for deeper understanding apply to other complex systems beyond the stock market, perhaps even within your own areas of interest or work?